All right, now let's head down to the lot where Tom Brady is trying to track down our Hertz customer.
I'm here, Vaughn, but looks like I just missed her. She's a Hertz Gold Plus Rewards member, so no waiting in line at the counter for her.
That means she's able to pick any car she wants. I mean, do you think that she treated herself to an upgrade and maybe went with a premium SUV?
She did go with that upgrade, Yvonne. I know it wasn't an easy choice with all the great vehicles here. Skip the line and get right to your destination. That's why you go with Hertz.
For a little savings, Specialist Miller buys in bulk.
Hey, what's up, everybody? Good morning. All right. Good morning, everybody. What's up? What's up, Louie? What's up? Right. Don't forget to smash the like button, everybody. S&P bear short up below monthly hedge pressure, looking the downside here this morning. VIX. Yeah, so bear setup today. Just gonna draw on the big screen here. S&P here to here. Right. Resilience is down. Everything's down. So everything's down. Keep my eyes peeled for hedge pressure break to go to the upside. There is some intermediate support off of Qs. Qs monthly resilience is very negative though, 57. Good morning. Okay. Short setups today. Yeah, that's exactly right. Resiliences are negative. Monthly resilience is negative, so any touching of monthly resilience is resistance. So today is downside stuff today. Market's going to continue to try to go down. Yep. My plan. So here's the first bounce possible from here to here. That 2 trade is always a possibility. With monthly res being negative though, it's likely not going to hold. Even if it bounces up, here all through here is short setup. We're breaking MHP today on Nasdaq, so market's pulling back. We're gonna sell. And yesterday, you guys remember, I didn't want to touch the market yesterday because the way that it looked, and we ended up falling what? The S&P dropped over 100 points between yesterday's open and today. So while the market, when the S&P was kind of bouncing around in that mean reversion, what I tell you guys is that, you know, once those trades are balanced, I don't touch it. It's a coin flip, whichever way it goes, up or down. Good setup, good setup. Jolt's incoming. Yep. Right, correct. So we're right on the edge. Neat how we're like literally right on the edge with the DD as well. So kind of slightly falling. Let's look at that. Jolt's, no wait, this is not. I mean, hold on. Jolt's already came out. No, sorry. Jolt's 24 minutes. My bad. Yeah, I was like, it didn't come out yet. 24 minutes on Jolt's, and I had the ISM manufacturing PMI today as well. All at the same time. It's going to be a catalyst. So those numbers that pop us, what I'm going to be looking for is if on the event, if there is a break, if there's a setup from here to there, only on the break. So once it gets here, this guy usually is going to be something that gives me key evidence of how it's going to behave. So shorting off of MHP is a very strong, so the pivot's really tight. So the easiest thing about these kind of setups is the pivot is tight. You know exactly where it's either going to make or break. If it goes 10 points in either direction, it's going to keep going. So, you know, any shorting beyond here, you're just bag holding. Any longing down here, bag hold one. When you click the yellow liquidity map, if LDM pops up, Lee, right here. You didn't know that? We changed that like last year sometime. Because maybe I need to update the videos. Well, for the marketplace, I am for sure. This Legend of Zelda lo-fi music. This is definitely Breath of the Wild. I want to put on something else. I love it, but I want to put on something else. I put on some generic lo-fi music. The ocarina sound is making me hypnotized. When the BRSU shows up. Okay. Oh, this right here. Yeah. That also. Yeah, that's always been there. You guys don't know that. That also came with that patch. I just forget that we have it. I sometimes forget about it. We have so many little features here. It was supposed to be in the platform down here, and then the developers put it here and said, we like this better. I know you didn't ask for this, but this is where it is. And I'm like, oh, that's even better. So, yeah, just put educational stuff in the platform is kind of one of the neat things we're going to have. Yep. I'll admit I forget about it too. Did you guys get we got here for the teaser for liquidity for the marketplace stuff, and I give that out? Pretty cool, right? Okay, so a couple things. Officially, number one, we officially partnered up with AMP Futures now, so we're live with them. You guys can about to put us on their website and everything, the platforms. We're gonna feature them on our marketplace, all kind of stuff. They're going to give us $100 deposit for minimum $100 deposit for trading. So for those of you that want data feeds and y'all may be using another broker with a $500 deposit and you guys are like, ugh, it's now 100. So we switched for that. You guys can have your CQG data feeds for much less deposit. And that's a whole new thing. Speaking of CQG, they invited me to the baseball game tomorrow. They're in here. They're in from Chicago. We're all gonna go to the Astros together. Me, the CQG, and a bunch of industry folks in the futures industry. That's kind of cool. I'm excited to see who I'm gonna meet. Not really sure. know a lot of people in futures, like by name. Met some of them, like meetings and stuff, but we'll hang out. So tomorrow is industry night. The pros and cons of Amper's Edge Clear. Yeah, I'll build a little table of the two. The Edge Clear, great broker. You know, nothing against them. It's just when it comes down to some people just want an account for futures data, then you know, Edge Clear requires you to put a $500 minimum deposit through Dorman. AMP is their own clearing firm, so they're an FCM directly, and they require $100 minimum deposit. So straight up, that's one thing. Number two is we're probably going to have slightly lower commissions there too. Nothing, like I said, nothing against Edge. They're still available, but typically when it comes to FCMs, you're going to want, there's two things that really matter. Number one is that minimum deposit, and number two is the commissions. Number three would be margins if you care about day trading margins. There's a pros and cons. I don't want to list a pros and cons list officially anywhere, because it seems like, you know, to call something that's not terrible or bad a con. I hate to compare one thing to the other, to kind of like, but what it's gonna be is like, I'll put the commissions up there, but I think that they win in every category for that, the things I listed. So like intraday margins, I think they do like $300 contracts. You have to apply for it, and so commission cheaper, deposit cheaper, margin cheaper. How do monthly maps look? Yeah, let's talk about it. But like for me to like publish, hey, up here's a pro and con list, I want everybody to switch or whatever, that would just be kind of, that would just, like the dudes at Edge Clear are nice, and that'd just be like a slap to them. But I'll list everything in both brokers, and you guys can decide on your own. I won't say pro versus con. But obviously, like, you know, when it comes to us, we're always looking for value for y'all. And the $500 deposit was a deterrent for a lot of people to go get futures data. Until we become a futures vendor of record, or we become our own data feed that we can supply, which we eventually will, you know, when we get big enough with marketplace and all that, we'll just have the futures data feed. You can buy it from us. No more brokers required. But again, that's another expensive step. Monthly fees. There's not a lot of, you know, justification for that now. If we had thousands of futures traders, it makes sense. We just kind of have like many hundreds. When we do that, we'll switch that and get rid of the little broker thing. But the idea is like now the CQG tunnel for the brokerage account, FCM data feed connection is like the way to get data for $3 a month. Oh, the monthly cost for data, I think their top of book is $3 a month versus what I think Edge is like $1 a month. So slightly more expensive data, I think. But don't quote me on that. I need to get all the info. But what we'll do is in the marketplace, brokers will be listed also with their own page. You can compare them side by side. So you'll be able to compare two things, I would think, that way. So QQQ, does everybody see on my screen real quick? Let's draw the monthly maps. Let's make this bigger. So yeah, this is all downside move today. Y'all can see how obvious the setup is. That's what I love about our tools, especially on the short side. Very easily recognizes it. A lot of people might have seen yesterday's stuff, want to buy the dip. So today, the only dip possible is that MHP on Qs. And also we have information coming out. 16 minutes might provide some catalyst. Okay, so the top of the bear zones are sloping up, the bottom of the bull zones are sloping up. Oh, let me open a monthly map. When you go to read this, and again, this is all available inside of our Discord or on the website. Click on my screen here. Windows, stop telling me what to do. Whenever the bottom of the gray is sloping up, bears are shorting more. So over the next week, you have more and more more and more shorts in the money at this current price. See how the current price as the days go by has more bear zone above it. So it means there's more people practically shorting here, more puts being bought at or near the money. And so that hedging is going to push it down lower. The bull side, same thing. Bulls exiting positions. The sloping up of the bull side is showing there's liquidation at this current price. There's fewer and fewer calls in the money around this region versus the where the puts are. So the spread is very clear. Now, volatility decreasing or increasing have to do with the distance between them. There's not a lot of distance between them. So the idea is that when the market, when it's nice and smooth and clean like this, it's just nice and smooth and clean on the downside. So when we see those monthly maps look like this, when they're both pointing down, we usually will see that as a bull market that just stable over time. This is like maybe a month of data, just pushes higher and higher and higher. It doesn't really like get volatile and jump up. There's not a lot of V's on the way up. It just kind of moves higher and stable, right? So when you have the same effect here with no volatility, you tend to have the market just moves lower and consolidates. It looks a little different because shorting and longing move the market differently, and then falls and consolidates and falls. It's not like this. You see that a lot in like volatile markets. Non-volatile markets just fall and fall and fall quickly. And stable. It doesn't bounce up and then fall down. It just falls. There's no buyers, there's no buyers, there's no buyers. The sellers drop it, the sellers drop it. So while volatile markets tend to move things faster, this actually just moves its way slower. It just trades lower throughout the day. So this is like, again, many weeks of data. It's like this is many weeks of data. So on the daily chart, what I'm trying to demonstrate is on the daily chart, bull markets just, you know, they don't dip much, they move up. And on the bear market, you'll have like really large candles on the daily, but in the intraday it'll just kind of like trade lower and trade lower and trade lower. It's not going to be like crash. So it's going to just slowly move its way down. This is what I'm trying to say, but slow and smooth. But the thing is that long markets move up slower than short markets. They usually move down faster because the put the call ratio is typically greater than 1 in a bull market. So therefore you just have an overwhelming amount of sellers there, push the market lower. Let's try to find an example of what I'm trying to say. So the idea is that you're not going to have a lot of big V's to go with it. Like the example is that here's some volatility. Yeah, this is like volatility right here. Look at my screen. When volatility is present, the market falls and then retraces like a lot of it, and then holds and then falls. There's a little like V there, you know, and it just kind of moves lower and then You see how it's chopping while it's moving down? That's not what we're going to have. What we're likely to have is something more along the lines of... It's been a while since we've had some bear market, so let's see. Something to resemble. It would be more like this. Maybe I'd say more like this. It falls, and then falls, and then falls, and then... You know what I'm saying? It's not chopping all over the place. So the type of selling is likely to be like this. Non-volatile selling, if it continues. So it's going to be more like... Instead of chop, 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 it's going to be more like fall, consolidate, fall, consolidate. Boom, boom, boom. Which ultimately will pick volatility up. But the non-volatile selling is simply just a small, smooth, consolidated, tight range selling, just like that. You see what I'm saying? So the idea that somebody's like, I'm going to buy some zero DTE puts, the market's going to crash and become rich. Not really so. You're not going to get some big momentum plays usually. It's just straight up bearishness and selling. So this type of selling it's dangerous for the long side. It's not super volatile for the short side, but it's consistently pushing lower, and this is easy to see that. So again, we can completely be turned around once the new information comes out. You can see how the market is not like chopping all over the place and dropping lower fast. It's just slowly selling itself off. That's the mechanic that you expect to see in non-volatile liquid bearishness. It's just straight selling. There's a little bit of bulls liquidating. There's a little bit of shorts entering the picture. And most of the rest of the market's kind of holding still through earnings. A hot link to the monthly map key at the top would be really dope. Yeah, it would be nice. So we're revamping the platform right now with all the new features, the new marketplace platform. So when the marketplace comes out, the platform itself is going to be free. Free rocket scooter charting. The charting platform is going to be 100% free. If you just want charts, it's free. If you want to add the tools that we sell or the tools anyone else sells, like I said, when we launch, we have about 50 vendors already. And they're all going to be selling different stuff. We're releasing that marketplace product in phases. Like we're going to be listing different things at different times. But the new platform itself is going to be like a free version, not too different from TradingView. So you see how the market's just kind of moseying its way lower. Now just be careful, because at the 9 o'clock, which is what we're waiting for, once that the PMI numbers come out and the jolt, which is kind of the bigger deal, that's going to push the market pretty rapidly. So, and what we've noticed lately is that in the last month, y'all have seen those catalysts have been big market movers, right? So let's look at the jolts. The jolts are going to be helping us understand what we think the Fed's going to do. For easy description on that. As the job market repairs itself, there's going to be fewer and fewer and fewer available jobs. But additionally, if companies are starting to reduce the amount of hiring they're doing because they're closing jobs out, because they're stagnating, the jolts also come down. So how do you know if it's bad jolts or good jolts when the number is coming down? Clearly you might say, aha, fewer job openings. This is good. It's good and bad, because if y'all remember during COVID, jolts plunged once companies had to shut the doors as well. So lowering jolts can be both ways. So the way you complete the puzzle, very simple. You look at the Thursday report. It's a little trick I love to teach. You go to continuing jobless claims, initial jobless claims, and they complete the picture. So if jolts are lowering, which they have been, and the continuing jobless claims, which are people that are claiming unemployment, as you see, it's also stagnating and slightly coming down. It's not increasing. So this is like waves of layoffs, you know, getting people on unemployment who are, you know, from here to here are getting jobs back, and from here to here are getting jobs back. So it looks like we've had over the years, right? 1, 2, 3, 4 waves of layoffs kind of across the board. And ever since about November of last year, that number has been somewhat in decline-ish. I guess volatile, now decline. So people going back to work, while jobs are coming down, it means that there's no new job creation at the rate at which people are filling the jobs. People are getting their old jobs back, which is good for inflation. The longer it takes for people to get a job back in an inflationary environment after they're laid off is directly proportional to the amount of salary reduction they're willing to take to get that job. That's a sign of desperation. You've been unemployed for 3, 4, 5, 6 months and you finally got a job. It means the competition is high for the jobs, and therefore you're accepting a lower salary relative to your competition. So there's more workers in need than there are jobs available, and that always brings inflation down, which is a good sign. So as long as the unemployment numbers come down and jolts come down, you can bet that people are going back to work, which is stabilizing the economy, right? As fewer people are getting laid off, it's good. There's not like a surplus of jobs and a lack of workers, which is going to drive wages up and drive inflation up. So this is a disinflationary kind of thing, which I like. Now let's look at the initial jobless claims. This is the one that showed people that got fired this week or last week. And as you see, ever since 2022, 2023, it's just cycling in the typical range of 200,000 to 300,000, which is pretty normal. It's a really normal range. So not bad, not good, not terrible. I know COVID always skews the data. You have to scoot it over. But you can see, like in the bull market, since the last crash, right, it's just been year after year after year. 2015, the beginning of Trump era world, we were at the 200,000. So where we are now, 200,000, we're basically back to normal. When it comes to, there's not like waves of layoffs, right? There's just people that have been laid off, probably because they're getting paid too much money for this job they've been doing since the post-COVID world. Everybody got a bigger salary, and now they got laid off in these cyclic waves, and now they've been sitting here, you know, since 2021, 2022 without a job, waiting for their company to hire them back. The example is you made 100 grand a year. You got laid off for a couple months during COVID. You came back, you went to work, and they're paying you 150 grand at the company next door because they need a job really quick, and you jump there. And then a week later, you jump somewhere else for 175, and your salary went way up, and everybody did that. And now the salaries are slowly starting to come down as that buffer of unemployed folks are not able to get their job back because the companies are healing up and there's more qualified people for the job, willing to take a lesser salary because they've been unemployed for a long time. They're desperate and they need to pay their bills. The longer people are laid off, as a rule of thumb, and the number of jobs available remains fixed, salaries always come down, because you're going to now be like, well, now I was making 175. Companies are like, yeah, but that's your COVID salary. Nobody's paying that anymore. Well, I'm going to hold out. Maybe I'll find it down the road. And then you wait, and then your buddy gets your same job for 150, and then his buddy gets the job for 140, and you're like, holy crap, I better get something for, job still up, so I need to pay my bills. And you jump back in, you're right back at your usual salary the longer you wait. Or the longer you wait, the more desperate you are, and the more willing you are to take a lower salary. All those cases point to lowering wages, which is lowering inflation, which means the Fed is no longer going to raise rates, which is good. And we've never seen them raise rates since this trend started pivoting anyways, and we call it way back. So even now, this trend is signaling that the Fed is not going to raise rates. Clearly, we know that. But at least you can build that inference from the data that you got. And seen. All right, are we trading? Should we be considering seasonality? As we were trading, should we be considering seasonality? So the answer is that's completely up to you. I, for one, I know there's some statistics in seasonality. I'm not the expert on it because I've never believed that pure seasonality exists, because it's so hard. You get like times of the year that happen once a year, and every single year something new is going on in the news. Every single year, every 4 years, there's a new president. So it's kind of hard to have like a baseline seasonality that says like, okay, during the holidays it typically does this, or during the winter and the summer it typically does this. There's general trends, but it's hard for me to adopt such a few amount of data sets with noise. If you think about it like this, in the last 100 years of trading, there's 100 different seasons, 100 data points to analyze seasonality. Here's our results data coming out. And so the reason I don't adopt it is because it's still too few data points to make an assessment. Because if you think about that, every president's gonna have a completely different economy to go with it, a different Fed chairperson to go with it, a different way of behaving in the market. So every 4 years, your data gets skewed because of the whole new layer that's added on top of it. So not only do you have only 100 data points, but you only have sets of 4 to really choose from. And then like every 10 to 15 years, there's a war that goes in there. So that chops it up even further. If there's like thousands of data points that would imply something, it'd be great. But it's really hard to say that what really happens at this time of the year in general, because there's no in general. We haven't had a stride of like hundreds of years with the same president and no wars and no depressions and no recessions, right? So it's, to me, any data suggested by seasonality is likely slightly suggested and mostly noise. And that's why I have a hard time adopting it into my trading philosophy. But it's not a bad thing to do, because there are seasonal effects that you can't deny. It's just the impact that they have is hard to determine. So if you like say like, okay, you know, the Christmas rally, people say that. And so more often than not, there's a Christmas rally. Well, why is that? Well, more often than not, markets are just bullish in general, and more people are employed, and therefore more people are willing to buy more stuff at Christmas time. And that would make sense. It's a logical conclusion. But then what happens if that year there's something completely different or weird going on in the economy? How strong is that rally? How strong is it going to deteriorate? What's the magnitude? You don't have a lot of details to suggest like the severity of, okay, there's a lot of layoffs this year. How bad are we still going to have a Christmas rally or not? You see what I'm saying? So great suggestion, Daniel, because while in an investing sense, you want to add every single layer of information to your investment decisions, and it's just hard to quantify. That's where I'm going with this. While seasonality does exist, it's hard to see it purely underneath the effects. So it's like, how do we take all the data of the stock market and remove the effects of Republican versus Democratic president, remove the effects of Vietnam, Afghanistan, Iraqi wars, from all that data, and really just see what's going on purely in the economy. Remove the effects of inflation, remove the effects of high interest rates versus low interest rates. What's our stride of data? What's our baseline to compare seasonality against? It's really hard to say. Just a solid stride bull market, maybe Reagan era from the 80s. You'll probably see it have like a stronger correlation where the market doesn't have a lot of catalysts to bump it after the 80s crash. Before the 80s crash, a nice little clean ramp up. But yeah. So the reason I say that is I've never put seasonality into the mix of my analysis methods, but only because I don't trade long-term enough to care, number one, usually. And number two, because it doesn't really affect my day-to-day day trading more so than the pivots and structure reading, methods we already have. But the other thing is that in the investment sense, I've never really seen it applied consistently, because it itself has lots of extra factors that you have to kind of account for. And so with the major factors being, like I just mentioned, like who's the administration, what are interest rates like, what's the Fed doing, are there any global things going on, are there any weird things going on. Seasonality is very, very appropriate for futures. I'll say this. Let me start with that by saying, when it comes to commodities, there's a lot of things that are very consistent seasonally. Crops grow at a certain time, they're harvested at a certain time. This is a very known effect around the world. Natural gas prices tend to go up when it's a colder winter across the board. So if you can identify weather patterns, you can be really good at trading, you know, natural gas futures and heating oil futures. Severe El Nino years tend to have colder weather winters, so you would have higher futures prices in those years. Here's your slow, stable sell-off that I was mentioning earlier. By the way, this is kind of just readily doing so. See how the market's not collapsing on itself, it's just trying to trade lower. This is what you expect to see. So we've returned to the starting point of the event. So today I'm just going to watch the market fall. I'm not getting a good pivot off a monthly hedge. That's the only place I do short. So I'm just watching it. I'd rather it just fall, and then maybe the market turns bullish again. I'd like to catch it. It could be selling for the rest of the week. We'll see. So in day trading, Daniel, I don't use seasonality in day trading. In investing, it's more appropriate, I think, but it's harder to visualize the impact and the effect. Because it's just so, there's only been 100 winters in the last 100 years. That's the way I see it. So one data point a year with all these extra factors make it hard to create a really solid data set to really trust the effects of the statistics of it. All right, it's May 1st. Well, what day will Marketplace be released to everybody, not just closed beta? The planned release on the Marketplace is the 6th. The 6th of March is the planned release. 6th of May. Did I say March? I would say May. We had a meeting last night about our last of our punch list items. Now for you guys, there's not going to be any change. The Marketplace is going to be released and then teased, and we're going to go public with the announcement and start doing podcasts and spaces and stuff again, just to kind of get the word out there. For you guys, nothing is going to change. You're not going to use the Marketplace just yet. Unless you want to go buy Discord Trade Room or something somewhere else. Like our tools and our things aren't going to be segregated out from the current platform. The Pro Plus, as you see it now, will still be sold. What we realize is that the hurdles to create the different products out of the scanner and all the different things is just a lot more work to hit that May 6th release. So the next release after the launch, we'll roll out Rocket Script and we'll roll out the indicators and stuff in the following weeks, a month. So like the first rollout is the Marketplace, the UI, the new dashboard, the new database, the new everything, the new platform, a whole bunch of new vendors with different things. We have some trader funding programs there. We already we have some brokers there already. We've got a lot of big names out there already, big name trade rooms, a lot of our friends. And you'll just be able to like play around with it and peruse it and check it out. And as we roll out the features one at a time, it's gonna be great. Rocket Script's coming out soon, indicators coming out soon, scanner coming out soon. The features will be rolling out in chunks. So we're really excited. So before the end of summer, everything will be rolled out. So it's not a long wait for all of the things we've built to be rolled out. Which is great. When I say all the things, I mean like all the things. We have newsletters, integrated education on the platform, all the rule assist stuff we talked about, all that stuff is the bigger push. With how many vendors? Likely close to like 50. Yeah. So about 50 vendors already. Yep. I'll give you a statistic. Everyone we've talked to has said, oh my God, yes, we'd love to be on your marketplace. We've run into one person that's said, no, this is weird. No, thanks. People are unanimously like thrilled to join. Many of them join during the initial meeting. Like, how do I sign up? Can you walk me through it? Yep. Gotcha. Because the value is there. There's nobody doing what we're doing. Vendors that have like indicators that they want to sell. They love the idea they can code them securely. There's really only one place you can securely code, and that's kind of NinjaTrader. But everybody we talk to that uses NinjaTrader is ready to abandon ship. Just because the technology that we have is much newer and faster and all that stuff. And they don't have to distribute files to people and manage licenses and give people access, take access, all this manual work. We've automated the whole process. So that idea alone is got pretty much anybody that makes an indicator, anybody that makes anything excited to have a new place to do it. TradingView folks have limitations on what they can produce. You know, TradingView customers have to buy tiers of the platform to get more indicators on their chart. Indicator creators can only have so many outputs from an indicator. They can't write infinitely complex tools. So we have both things, unlimited for users and unlimited for creators. So we even beat TradingView on the value as well, as far as what people want that create indicators. And so most people, when we demonstrate the technology to them, and you guys are seeing the technology right now, resilience, liquidity maps, DD bands, all that stuff, transmitted to you from the server. These are all server calcs. So we're the only platform doing that, which allows us to have unlimited experience for people. All the indicators are calculated on a server and then broadcast to you. So that's a neat thing that we invented. And that's a very useful thing because now users don't see your code and you don't have to distribute anything. You don't have to manually give out licenses, give you access. You go to the marketplace, you buy it. It's immediately in their platform automatically. If they don't pay their bill, we take it out of their platform, easy as that. And the code is never able to be accessed by any of the users. They can't hack into the browser and get it. They can't hack into the platform and get it. So it's like we went on all turf, all terms. So people are very excited about the idea. We've created 4 white label platforms. So we've created trading platforms for 4 different people as well. All inclusive, one-stop shop for them. Just like Pro Plus that you guys have is a, we can call it quote unquote a white label of Rocket Scooter. It's an all-inclusive experience with our logo at the top. We've created 4 of those for other people. They're going to be released at different times. One of the companies has hundreds of indicators and algorithms. So they're going to have their own all-inclusive experience. So people can either put their indicators in the base platform or create their own platform. If you have the software out there and you want to make your own trading platform, make it for you. With your logo, your branding, all your stuff all packaged up inside of it. This is crazy. And then as marketplace rolls out, our company is going to split its focus, into 3 different places. We're going to have our dedicated team fully back to upgrading our tools for our vendor experience, Rocket Scooter vendor experience. So you guys will have more tools towards the stuff we trade with on our end. So my own things. The other 2 things are going to be focused on marketplace deliverables, and then a dedicated staff for the white label business, which builds platforms to other people. So we're gonna like staff up and hire more people, and there'll be more folks at Rocket Scooter working. That's a good sign for all of us. If I can predict or control the weather, I can make a ton of money. Well, absolutely. Here's a trick. Gallon Almanac, and every single time there's a hurricane, this is my own trick. I just haven't been able to utilize this because we haven't had a good one in a while. But let me draw this awesome drawing of what's known as the United States of terrible drawing. All right, that's kind of Florida and that's kind of Texas. All right, anytime you have a hurricane, is that the correct way it spirals? Anyways, hurricane come into the Gulf of Mexico. This is barrier 1 from the Atlantic. So anytime 1 happens and 2 happens and touches landfall, anytime this happens, if I were to draw what I like to call like the snow line, which is, does it snow a lot here or not snow a lot here? If the average winter like snows here, if this happens, this line gets lower the next winter. This happens in the summer, it's going to snow over more of the US this year. So in the summer, if it's a large enough pressure differential to allow such a high powered force to enter this low pressure system, to enter in to this large heat sink of water called the Gulf of Mexico, then as the low pressure system moves out, the lower pressure return is the cold air from the top that's more dense, pushes its way lower and therefore further across the country, and it's colder in the winter. So hurricane touches the Gulf, you will have a colder winter, which means it'll snow more, which means more people will buy heating oil and natural gas over more of the United States. Futures will go up. So in the summer, when this hits land, it will be a colder than normal winter. Use that to your advantage in your trading. Get out an almanac. There's a very consistent trend there. Speaking of seasonality and commodities and things, that's one of the things you can predict the weather. You can see that. So it has to do with the way pressure works, and clearly it's hard for a hurricane to touch land. A lot of times it just, hangs out in the Caribbean and disappears. Sometimes it'll push in and not touch land, but if it pushes in and touches land, it's usually pretty severe. Hurricane Harvey, Hurricane Katrina, they've all been category 5s. So every once in a while I might get a tropical depression come through, but if something is in the ocean and it pushes all the way through and then hits land, it usually snows in Houston. And that's how I know that, because it snows here like 30 times in the last 100 years. We've had snow days where it actually snowed. So it's such a rare event to have snow in Houston. Like in 2008, there was layers of snow on the ground, and they had Hurricane Ike that year. So keep that in mind when you trade. That's just a signal that it's likely to. I started noticing that because when my friends and I were talking about snow years, we were like, "Oh yeah, it snowed." Remember that one year in Harvey it snowed? They're like, "Yeah, I remember that one year in Hurricane Ike it snowed." Remember that one year in after Allison, a year later it snowed, and we're like, "Yeah, oh wait, every single time there's a tropical storm or a hurricane, it snows." And they're like, "Oh, I wonder what that is." And we're all engineers, and we're all like, "Well, it probably has to do with the low pressure systems and blah, blah, blah. El Nino." Anywho, it's a neat little trend. It just implies colder than normal winter here, which means everybody above us will have even colder than normal. So it's likely that more people in these, like, on our parallel will probably be cranking on their heaters. And so likely note that I don't think maybe Wall Street understands that trend. I don't know, but you would assume that maybe that could affect, NG and heating oil futures from the summer leading into that winter. So, right. You think that in the summer and the hurricane hits, you're like, "Oh, I want to buy some." Buy some leaps on D gas or U gas. I don't even, I mean, those are still a thing. New gas and degas. I don't know. Buy some long-term options on those, just in case price goes up. Yeah, so see how like it's a like a kind of fun loose correlation. But yeah, it'd be kind of neat. Thank God we haven't heard a hurricane, but also we had a snow day in a while either. So good morning. What's up? What's up, Cheyenne? Good morning. But Garrett should pick up the speed on the downside if we eclipse 50-30. I definitely agree with you. Yep. You see how the market is just moseying its way lower? This is what I was describing this morning, non-volatile selling. It's just, there's not a lot of buyers here. It's just a quiet market, and it's just hitting little burps. But yeah, so that's it. All right, so anyways, marketplace stuff, working on that today. I'll be around. Appreciate you guys' patience as we're kind of wrapping up the final week. That's why I'm not able to do much. I'm streaming shorter. I'm not able to do Zoom calls or whatever. It's just like nonstop working on this. Cool. All right, we love you guys. Take it easy. I didn't get my monthly hedge pressure tap, so nothing to work on. All she does by August to provide natural gas supply. Use that info to predict the coldness of the winter. Hey, there you go. That's helpful. Just try the hurricane trick, or at least go look at the data yourself. See if you have any any additional info for me for that. That's just I've never traded with that knowledge. But there is a trend. So it'd be cool for somebody to build and compile that data. Like the average, like if you were to take the way to build that data to divide the United States into maybe like 4 parallels. Let me just draw. Here's the United States again, very quickly. Okay. And you were to say like, you draw these into regions. It'd be cool to see this. Like if this was region 1, you know, region 2, region 3. And you were to draw like the average winter value for each region. I don't know, or the winter temperature year at like a point in time. Like pick a fixed point. Let's just pick an example like Christmas Day, or the average winter temperature over the winter. So you have like data points for every average winter temperature here, and you were able to see that if you have zone 1, 2, and 3, and you were to pick a point of like, maybe I'm gonna pick an example like 50 degrees Fahrenheit, okay, that the sum of the average temperatures in your region, you had more and more of all regions below 50. Like I would say that, I'm just trying to demonstrate this. But essentially, a percentage of the country that's under 50 degrees, for example, average for their winter. And that you would see, instead of, I don't know why I'm just slipping these up, but instead of them being, if there's like a hurricane year, you would see like more of them lower. Like the hotter stuff will be drawn into that little subset. So if this is 1, 2, and 3, 1 is hotter than 3, 1, 2, and 3. Like you'd have 1 and 2 and 3, so you have more of them below your little benchmark. Like what temperature do I turn my heater on at? 50 degrees, 60 degrees, 40 degrees, whatever. So you'll see like more of the data down in here. And if you were to set up a graph like that, you likely see like, you know, the cold stuff is going to stay colder, like that. It's like the average temperature which people turn on heaters. You'd see more of the country turning on their heaters in hurricane years. If you put that side by side, I'm sure you can draw a really good data set off of that. Pretty consistent. Again, like we talked about seasonality, there's not a lot of data points. And we get a hurricane every 5 to 10 years that touches land. So you don't have a lot of them, but I do know that there's some science to that because it has to do with the and El Nino, low pressure, and all that stuff. Like by parallels. Yeah, Garrett said like by parallels. And you were just to see like by square area percent how much of this parallel is below a temperature gradients. And you could do like below 50, below 60, below 70, and you decide when do you think people are going to turn the heaters on, how cold, and then you have your data to say that it's suggested that when a hurricane touches down, 70% of the country is not going to have a average winter that's less than 50 degrees Fahrenheit. And a nice little data set like that would be great for you to set up a little monitoring program. Type in your data once a year and track it in your Excel spreadsheet. And go. Dang, it's a little humid. Like, you know, they get 3 tropical depressions hit the coastline in Texas. One of them hit Mexico. Okay. Could be a colder winter across the US. Cool. All right, I'm gonna get out of here, y'all. We will see y'all back tomorrow. We'll go get my amp count set up. Yeah, we love y'all. We'll see y'all later.